If you're over 55 and have been watching your dollar buy less and less each month, this video could save your retirement. The uncomfortable truth is that since 2020, the dollar has lost 25% of its purchasing power. But what if that's just the beginning? What if we're heading towards something much worse? Hyperinflation. I'm going to show you exactly which assets get completely wiped out during hyperinflation, and more importantly, the 5 strategies that have protected wealth for centuries, even when currencies collapse. Stay with me, because by the end of this video, you'll have a clear action plan to protect everything you've worked for. I'm Host Name, and for over 2 decades, I've helped thousands of Americans protect their wealth during economic uncertainty. I lived through the stagflation of the 1970s, the dot-com crash, 2008, and now this current crisis. What I've learned is that the government and Wall Street won't save your retirement. You have to save it yourself. And right now, we're facing something that could be far worse than anything we've seen before. Let me be clear. I'm not here to scare you. I'm here to prepare you, because knowledge and action are the only things standing between you and financial devastation. First, let's talk about what hyperinflation actually means for someone in or near retirement. Most people think inflation is just higher prices at the grocery store. That's regular inflation. Hyperinflation is when your currency becomes essentially worthless. We're talking about prices doubling every few months, or in extreme cases, every few days. Now, I'm not saying we're definitely headed for hyperinflation, but the warning signs are impossible to ignore. We've printed more money in the last 4 years than in the previous 50 years combined. Our national debt is approaching $35 trillion. Foreign countries are moving away from the dollar. And most concerning for retirees, the very demographics of our country mean we have more people retiring and fewer people working to support them. Here's what this means for you specifically. If you're 65 today and expect to live another 20 years, even moderate inflation of 6 to 8% annually will cut your purchasing power in half. But if we see hyperinflation, even for just a few years, it could wipe out decades of careful saving. I've put together a detailed analysis of historical hyperinflation events in the description below, including what happened to different types of investments during those crises. But right now, let me tell you about the assets that get destroyed first when hyperinflation hits. The first casualty of hyperinflation is cash and cash equivalents. This includes savings accounts, CDs, money market accounts, and yes, even government bonds. I know this is painful to hear, especially if you've always been told to keep a significant emergency fund in the bank. During hyperinflation, cash becomes confetti. Next to get destroyed are fixed income investments. This includes most bonds, annuities with fixed payments, and pension plans that don't have cost of living adjustments. If you're receiving $3,000 a month from your pension today, and we experience just 50% annual inflation for 3 years, that $3,000 will buy what $888 buys today. The third major casualty is anything tied to the nominal value of the dollar without inflation protection. This includes most life insurance policies, especially whole life policies that have been sold as investments. The death benefit might be $500,000, but if hyperinflation hits, that might not even cover a year's worth of basic expenses for your surviving spouse. Here's something most financial advisors won't tell you. Traditional stock market diversification doesn't work during hyperinflation. Yes, some stocks can survive, but the entire concept of buy and hold and dollar cost averaging breaks down when the dollar itself is collapsing. Now, before you panic, let me tell you about the assets and strategies that not only survive hyperinflation, but actually thrive during these periods. Strategy number 1, physical precious metals, specifically gold and silver. Notice I said physical, not ETFs, not mining stocks, not certificates. During hyperinflation in Germany, gold retained its value. During the hyperinflation in Zimbabwe, those who had gold could still buy food and necessities. Gold has been money for over 5,000 years, and it will be money long after our current currency experiment ends. For retirees, I recommend having 15 to 25% of your wealth in physical precious metals. Silver is more volatile but also more affordable for smaller purchases. The key is to store it properly, either in a home safe that's properly secured or with a reputable precious metals storage company. I'll share the specific company I personally use in the description below. Strategy number 2, real assets that produce essential goods or services. This includes farmland, timberland, and businesses that provide necessities like food, energy, or housing. During the 1970s inflation, farmland was one of the best performing asset classes. People always need to eat, regardless of what's happening to the currency. But here's the key. These need to be assets you can control, or that have inflation escalation clauses. If you own rental property, make sure your leases allow for rent increases. If you invest in farmland, understand that it needs to be productive farmland with good water rights. Strategy number 3. Select dividend-paying stocks and companies with pricing power. Not all stocks get destroyed during hyperinflation. Companies that produce essential goods and have the ability to raise prices can actually see their stock prices rise with inflation. Think utilities, food producers, energy companies, businesses where demand is relatively inelastic. The key here is companies with strong balance sheets, minimal debt, and the ability to pass costs through to consumers. I've created a checklist of criteria to evaluate these companies. You'll find it in the description. Strategy number 4. Foreign assets and currencies. This is more complex, but if the dollar collapses, having some wealth in stronger currencies or foreign real estate can be a lifeline. Switzerland, Singapore, and certain other countries have much more conservative monetary policies. Strategy number 5. Skills and relationships. This might sound soft, but during economic chaos, your network and abilities become incredibly valuable. If you have useful skills, whether it's gardening, mechanical ability, medical knowledge, or strong community connections, these become forms of wealth that can't be inflated away. Let's talk specifically about real estate, because this is where I see a lot of confusion among retirees. Many people think real estate is automatically a good hedge against inflation. Sometimes that's true, but it depends entirely on the type of real estate and how it's financed. If you own your home outright, it will likely maintain its value relative to other goods and services. Your property taxes will go up, but you'll have a place to live regardless of what happens to rent prices. However, if you still have a mortgage, the situation is more complex. Yes, you'll be paying back that mortgage with cheaper dollars, but your property taxes, insurance, and maintenance costs will all be rising rapidly. Rental real estate can be excellent during inflation, but only if you can raise rents quickly enough to keep pace. Many areas have rent control laws that prevent this. And if you have a mortgage on the rental property, you might find that even with rising rents, your cash flow gets squeezed by rising maintenance costs, property taxes, and insurance. Commercial real estate is even trickier. If your tenants have long-term leases without inflation escalation clauses, you could be stuck receiving fixed payments while all your costs are rising rapidly. The bottom line on real estate, your primary residence that you own outright is good protection. Rental properties can be good if you choose them carefully and structure them correctly. But don't assume all real estate is automatically inflation-proof. Here's something crucial that most people miss. During hyperinflation, liquidity becomes incredibly important. You might own assets that are theoretically maintaining their value, but if you can't access that value quickly when you need it, you're in trouble. This is why I recommend having some wealth in forms that can be converted to whatever medium of exchange is working at the time. Now let me share what I call the golden rules of crisis-proof investing. These are principles that have worked throughout history, regardless of the specific crisis. Rule number 1. Never put all your wealth in assets denominated in a single currency. Even if you believe the dollar will survive, having some diversification into other stores of value is basic risk management. Rule number 2. Own things, not promises. A stock certificate represents ownership in a company's assets. A bond is just a promise to pay you back with interest. Gold is a thing. A bank account is a promise. During crises, promises get broken. Rule number 3. Prioritize assets you can control. This is why I prefer physical precious metals over ETFs, direct real estate ownership over REITs, and individual stocks over mutual funds. When things get chaotic, you want to be able to make decisions quickly without having to go through intermediaries. Rule number 4. Maintain some liquid assets even if they're not optimal investments. Yes, cash gets destroyed by inflation, but you still need some for immediate expenses and opportunities. The key is not holding too much and not holding it too long. Rule number 5. Focus on assets that provide utility beyond just investment returns. A home provides shelter. Farmland provides food. Precious metals provide insurance. Skills provide income potential. Don't just think about returns. Think about survival and utility. Rule number 6. Understand the tax implications of your crisis planning. During economic chaos, governments always look for new sources of revenue. Make sure your wealth protection strategies don't create unnecessary tax burdens. The exact checklist I use to evaluate investments against these rules is available in the description below. It's helped me and thousands of others make better decisions during uncertain times. So what should you do right now? Here's your action plan for 2026. Step 1. Audit your current wealth allocation. How much do you have in cash, bonds, and other dollar-denominated assets. If it's more than 50%, you're taking on significant currency risk. This doesn't mean you need to change everything overnight, but you need a plan to rebalance. Step 2. Start acquiring physical precious metals. Begin with gold, and consider adding silver for smaller transactions. Start small if you need to, but start. Even 5% of your wealth in physical precious metals is better than zero. Step 3. Review your real estate situation. If you're still paying a mortgage on your primary residence, consider whether it makes sense to pay it off early. If you own rental property, review your leases and local rent control laws. Step 4. Evaluate your stock holdings. Look for companies with pricing power, strong balance sheets, and essential products or services. Consider reducing exposure to growth stocks and technology companies that depend on cheap credit. Step 5. Build relationships and skills. Join local community groups. Learn practical skills. Develop multiple income streams if possible. Your human capital is just as important as your financial capital. Step 6. Create a crisis communication plan with your family. Make sure everyone knows where important documents are stored, how to access accounts, and what the plan is if normal systems stop working. Remember, the goal isn't to time the market or predict exactly when or if hyperinflation will occur. The goal is to position yourself so that you'll be okay regardless of what happens. As the saying goes, it's better to be a year early than a day late. The most important thing is to start taking action now, while you still have time to make changes methodically rather than frantically. Look, I understand this is a lot to think about, and some of it might seem overwhelming. But remember, you've already survived multiple economic challenges. You lived through the inflation of the 1970s, the crashes, the recessions. You have more wisdom and experience than you realize. The difference now is that the stakes might be higher and the timeline might be shorter. But the fundamental principles of wealth preservation remain the same. Own real assets, diversify your risks, maintain some flexibility, and don't panic. I want to leave you with this thought. Throughout history, every currency has eventually failed. The dollar has lasted longer than most, but it's not immune to the laws of economics and mathematics. By taking steps now to protect your wealth, you're not being paranoid, you're being prudent. Your retirement security is too important to leave to chance. The government's promises might not be worth much if the currency they're denominated in becomes worthless. Wall Street's advice is designed to benefit Wall Street, not you, but you have the power to protect yourself. The strategies I've shared today have worked for centuries through wars, depressions, currency collapses, and every other crisis you can imagine. They'll work again. The question isn't whether economic turbulence is coming, it's whether you'll be prepared when it arrives. Don't forget to check the description for the complete hyperinflation protection checklist and the companies I personally recommend for precious metals storage. And please subscribe for more retirement protection strategies. Your financial security might depend on the information in our next video. Stay safe, stay prepared, and remember, it's never too late to start protecting what you've worked so hard to